As the summer rally sizzles on, there's no denying this market has proven resilient, even when faced with the looming threat of a possible recession. The S&P has rallied 17% since the June 16th bottom, and we've seen decisive pockets of strength that tell the tale. Investors appear to be gravitating back toward large-cap growth and doing away with short-term credit as they attempt to navigate a possible Fed pivot. Joining us now to break down the trends is Tom Lydon, Vice Chairman at VETAFI, Matt Bartolini, head of Spider America's research at State Street, and Tim Johnson, Blue Horizon Capital partner and co-founder of Cycle. Guys, thank you so much for being here. It's definitely the trifecta today. Matt, let's start with you. Given the sudden shift that we've seen from kind of the recent rally, it seems like investors are a little concerned about risk, at least today, Friday. Is that what the flows are telling you, and what does that indicate about a potential trend, as we finish out summer and head into the fall?
Yeah, so I think what we've seen from buying behavior is that investors, are sort of acting as if it's a summer of cynicism. They're not really buying so much into this rally. Flows have been positive. There's roughly about 44 billion of inflows in the month of August alone, which is generally around historical averages. But over the past 3 months, that trend is definitely lower than what we've seen historically. We've also seen lower participation within some of the ETF marketplaces where not a lot of flows, funds beneath the surface have had inflows. Particularly in the month of August, if it was not for U.S. equities, which took in over 30 billion so far, the equity segment alone would have actually net outflows. So there's definitely been a lack of conviction. There's been a little bit of pessimism towards this rally of how it will last. We're obviously seeing some of that being given back today. The S&P 500 really failed to break above the 200-day moving average, and that's been a sort of a line of demarcation. There has been some positive green shoots, though. More recently, we've seen some positive flows into sector exposures. That's the first time they've had inflows in the last 3 months. But when you dig beneath the surface, it's still defensive positioning. Defensive sectors like healthcare, consumer staples, and utilities, those areas that typically have worked well historically in times of slowdowns or recessions, continue to be allocated to. So again, summer of cynicism. Perhaps we'll go to the autumn of optimism when we get to the fall time period.
Autumn of optimism. I like that. Tom, kind of along that same vein, in terms of hedging and short selling, ETFs often used as a way for investors to get exposure to both directional bets to the downside as well as hedging out specific positions in their portfolio. We've seen short positions kind of rise with the tide of the market in recent weeks. What's the sense you get there that it's a directional bet or fears that investors have that the market has just run up too high versus just the fact that the market, at higher levels requires more in terms of hedging?
Yeah, I'd kind of take the other side of the bet that Matt just laid out. I think advisors, and we're surveying advisors all the time, are the most positive they've been in over a year. We're seeing positive flows back into growth. We saw $42 billion go into growth ETFs off of that low. That's key and critical, very important. And also where we saw net redemptions in fixed income ETFs in the first 4 months of the year, we've actually seen money come back into corporates, into high yields, and leaving areas that were safer, like short-term duration, and also dividends. Got a lot of flows in the beginning of the year, and actually in the last couple of months have seen some outflows. The surveys we see from advisors are saying because the Fed is a little bit more clear on the rising interest rates and they're fighting inflation, they're less concerned about, yes, there'll be a recession, but how deep that recession will be. So then, in turn, translates into them being more bullish on the market.
Interesting. Tim, I just wanted to get your take, as we wrap up the broader market segment. Do you feel like that the overall sentiment is kind of at this inflection point?
Yeah, I think the reality is that this broad transition, as we look at it from the new energy economy, is continuing to be strong. There's clear leaders. There's clearly a whole bunch of innovators that have done a lot of work over the last couple of years. And whilst there may be short-term pullbacks, at the end of the day, we see that the trend is continuing. We see that enthusiasm for the sector remains strong, even if in the short term there's some skepticism around what's going to happen day to day.